something to gain and you're going to reinvest in something that's similar. It's something to really think about.
Can I bring in the foreign component here, Renee? And this is also where between the two laws people get confused. The U.S. law is based on a 1-year capital gain. Okay, so if it is more than 12 months, so 1-year capital gain. In India, it's 3 years. Now, you got to be careful with that so that you have to keep track of 1 year versus 3 years. So there's the first trap. The second thing I'll say is documentation, and I agree with Vinay. Someone asked me, can you offset a U.S. asset with an Indian asset?
Right.
Can you use 1031?
But that's
These
3
are
years versus 1 year,
correct.
so you
But
have
there
to
are very
work it
complex issues. You really need to consult an attorney or a CPA who is knowledgeable in international tax, because does that qualify? Yes, in my mind it qualifies. It does not state that that has to be a U.S. asset, the 1031 exchange. But these are complications that, unless you understand the whole facts and circumstances and get good advice, you might be looking at the wrong thing, or you might not be able to. And I know a lot of non-resident Indians who have bought property in India, either inherited the property or sold the property, and the first thing you want to know is that capital gains first is taxable in India.
What about inheritance?
Absolutely.
Inherited property?
When it is sold. There's no taxable event when you inherit. Zero.
Only when you sell it.
Only when you sell. But the basis becomes important. So my grandmother left me a $10 million property, which, or maybe she's not that rich. She maybe left me $1 million, but now it's grown to 10 million.
Right.
And the date of her death, that 10 million is important. And if I sell it for 12 million, then my gain is only 2 million.
2 million.
As opposed to, if you don't have the good basis, or if you don't have good documentation, they could charge that whole 12 million as a gain. And that will really hurt. So you want 11 million, actually 1 million minus 12. So folks, you have to be very careful. Just understand the basis. Whenever inheritance, you're inheriting property, gifts, whatever, the basis is very important. And once you get the basis...
Do you have to pay, let's say, if the gift is under a certain amount, you don't have to pay it all if you sell it?
Yeah, there's no
What
no
is
gift
that?
tax.
Is there a threshold?
In India, it's 30 lakhs. There's wealth tax, but there's no gift tax, so...
Tell us about some tax changes for 2013.
Okay, a lot of tax changes in 2013. So over 10 years ago, we had what was called the Bush tax cuts that basically did a few things. They took the top ordinary income rate down to 35%. They took capital gains down to 15%. And dividends, special types of dividends are taxed at 15%.
Right.
So those were supposed to expire December 31st, 2010.
I see.
There was a 2-year extension given, and right now they're scheduled to expire December 31st, 2012. So at the end of starting 2013, our ordinary income rates are going up to 39.6 top rate. Capital gains rates are going to 20%, and the special rate for dividends of 15% is going away. Okay, so if I earn dividends, that's ordinary income. Okay, so for many retired clients that we have that earn a lot of their money from dividends, they're going to have an enormous increase in their tax rate. Now, that's based on the laws that exist today. If Congress doesn't step in and change something, it's going up.
Right.
And it gets worse, because as part of the healthcare overhaul a few years ago, there was a new 3.8% tax imposed on investment income if your income is over $250,000. Okay, so for those people, the retired person who's making most of their money from dividends, if their income is more than $250,000, their rate is basically going from 15% this year to about 44% next year.
Wow.
Now, there's a lot of talk because the Supreme Court is weighing the constitutionality of the health care legislation is up in the air right now. So if it comes back that it's unconstitutional, the next question is, does the whole Health Care Act have to be stricken, which means that the tax goes away, or do just parts of it go away, which means the tax is probably going to stay? So you have to stay tuned. But chances are, if Congress does nothing, at least the Bush tax cuts are going away.
I see.
And we're going back to the 39.6% rate.
39.6%. Now, very quickly, we're really out of time. Cecil, tell us about the changes with the tax return forms with India.
Yeah, India has some major changes, and one thing I really am amazed that Pranab Mukherjee was on TV recently. There's something called the GAR, that is General Anti-Avoidance Rules. And there was, as part of the recent budget, they tried to initiate that act, which would have triggered a nightmare for all the foreign institutional investors. And that would pull a lot of money out of India, and all the foreign investors got nervous. So they have delayed the implementation of that rule by 1 year. So that's our good news. But there was a big battle because a lot of the foreign direct investment, it goes from US to Mauritius, Mauritius to India. 40% of the FDIs, foreign direct investment, is to Mauritius because Mauritius has a very favorable tax treaty. And that way they are seen in light of paying lower taxes by diverting the money instead of US directly putting that money into India, it goes via Mauritius. So the Indian government is hungry for money too. People forget that. So they want to equate the playing field, but there was a major push from, I think, even the US government, and there were some high-level talks to defer the implementation of GAR, as they call it. Second is double taxation treaty agreements. They always revisit this every 5 or 10 years. There again, there was something in there calling for retroactive application of law that they could actually, there was a major case called Vodafone, the cell phone guys, and it was huge because they challenged some transfer pricing, they challenged some intellectual property transfer rights, and I call it the soft side of things, where they could go back as 10 years or 15 years back and say, you know what, you owe us some tax based on this renegotiation. So it gives a lot of power to some taxing authorities, which, in most of the developed countries, they don't go backwards. They only go forward. So I think you should stay tuned. And finally, the foreign institutional investors get very nervous, and because of that, I think there was high-level talks between the US and India to make sure that law didn't pass.
Right.
And if you read a lot of this was as recent as May 2012, Renee. So I'd really, any major institution, hedge funds, they need to really stay tuned as to what are the tax law
So
changes
the
on India's
filing
side.
tax return for India is July 31st.
Yes, in July, it's an assessment year they call March. They start on April 1st to March of the year. So your due date is July 31st.
So we have to keep tuned to a lot of stuff, healthcare from United States, Indian tax rules.
Right.
A lot of things are changing. And at the same time, how to save your savings in such a way so that you're well ahead of the game in 2013. Thank you very much. Our tax experts today, Cecil Nazareth from IFRS Partners and Vinay Navani, CPA from Wilkin Goodham Plant. Thank you very much. And
Thank
I'm
you,
Renee
Renee.
Lobo. Thank you for watching the Renee Lobo Report.